Now, both of those terms strongly depend on the value of a security or of a stock in this case, and that's why it makes sense to take a little closer look at the various types of values that a security can have. And in the case of stocks, we can distinguish between three categories. First of all, there is the par value of the stock. This is also often called the face value of the stock, and it is merely the value at which a company originally issues a stock or share. It's very often written on the stock itself, and if a company issues a stock at a certain par value, then usually it will not be prepared to sell that share or stock for less than that value. So that's the par value. It's the face value on the stock itself. If the demand for this stock is sufficiently high, then investors will very often pay a higher price than this par value. That means that they will purchase the share or stock at a premium, at a higher price. This would then be an example of a market value that is different from the par value. Ultimately, the market value of a security depends on the laws of supply and demand, and that means that the market value is determined by the price at which a seller is willing to offer a security and the price at which a buyer is willing to purchase a security. Sometimes the market value is identical to the par value, but it can be higher, at which point it's said to be at a premium to the par value, or it can be lower, in which case we say that the market value is at a discount to the par value. Now, the third category of value that we find in the Ebert Griffin chapter is the so-called book value, and the book value has nothing to do with the value on any stock exchange. The book value of a share is based on the value of the equity in the balance sheet divided by the number of outstanding shares. So that means if we have equity worth 200,000 and we've issued 1,000 shares, then regardless of their par value or market value, the book value of each share is 200. If we'd like to evaluate whether a stock exchange is bullish or bearish, then it'll never be enough to look at the market value of just one of the shares. Instead, we try to take an average of the most important stocks that are traded on a stock exchange. And this average value that is collected is referred to as a market index. It is what we use to evaluate the performance of a stock exchange. There's literally hundreds of market indices or market indexes that value the development of stock exchanges, but I'm going to list some of the most important ones now. The most important market index in the world by far is the so-called Dow Jones Industrial Average Index, and it measures the performance of the financial markets by taking a look at the development of the 30 most important blue chip companies on U.S. stock exchanges. Now, a blue chip company is a company that has a solid financial history and is not expected to go bankrupt anytime soon. These are the industrial giants like Coca-Cola and Microsoft that we know. Blue chip companies very rarely reflect the performance of newer fast growers, dot-com companies, etc. Blue chip companies are the traditional segment of the old economy. Because of this, certain other U.S. indices, certain other U.S. market indexes take a broader look and look at more companies rather than just 30 blue chip companies. One example for this is the S&P 500 Composite Index. This is compiled by Standard & Poor's, and it consists of 500 stocks, as the name suggests, that are more widely distributed and, some say, more accurately reflect the development of the U.S. economy and the U.S. financial markets. Finally, Ebert and Griffin mentioned the NASDAQ Composite Index. We'll talk about NASDAQ a little later, but this is an index that measures the performance of smaller, less regulated companies and currently consists of 3,300 different companies. Now, the following indices aren't exam relevant. They're not in the book, but nonetheless, as international students, you should know that the most important index in Japan is the Nikkei index, whereas in Germany, the indices that are of, let's say, highest relevance are the DAX index as well as the Commerzbank index. Both of these track the performance of the major German companies. In Great Britain, by far the most well-known index is the Financial Times Stock Exchange Index, and it's abbreviated, or it's usually referred to as the FTSE 100 Index. It measures the development of the 100 companies with the largest capitalization on the London Stock Exchange. In regards to the most important stock exchanges in the world, Ebert and Griffin focus again on the United States, and without a doubt the New York Stock Exchange, which is abbreviated as the NYSE, is the most important stock exchange in the world. In the United States, a second stock exchange that's also located in New York City is the American Stock Exchange. It's abbreviated the Amex, and it has slightly less strict listing requirements than the New York Stock Exchange does. A city that gets overlooked a little bit in the Ebert Griffin chapter is Chicago, and Chicago should be noted because various exchanges in Chicago play an important national and international role. First of all, there's the Chicago Board of Trade, and there's the Chicago Mercantile Exchange, both of which are very important in the area of derivatives trading or commodities trading. Now, again, this is not exam relevant, but if we were to look at the 10 largest stock exchanges in the world in order their value, then the New York Stock Exchange would rank at the peak, but there's also other exchanges like the Tokyo Stock Exchange, the London Stock Exchange, Euronext, the Frankfurt Stock Exchange or Deutsche Börse, and the Hong Kong Stock Exchange that play an enormous role on a global level. Please continue by watching the next video.